All right. Today's Thursday, October 16th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. We have an important discussion because you saw what happened with the VIX today, huge pop, and it seems there is more where that came from. And we're beginning to talk about systemic risk in the financial markets once again. And I'm going to try to connect the dots for you from what's going on with the regional banks, what's going on with some of the private equity firms, and how does that connect with the Federal Reserve's policy, and then, of course, the hidden danger. Let's talk about it, and here it is, in focus tonight. But let's begin with what's going on in the SOFR market. Of course, this is the really short-term rates, and the expectations continue to pile up that the Federal Reserve is going to cut rates aggressively. And when we see, as you're looking at the chart right now, a stampede on call options in a massive way for SOFR for the December 96.5 calls, for example. The first question that comes to mind is why? Why would we see such aggressive rate cutting by the Fed? Because if it is, inflation is just coming down, we know that inflation is not coming down, and the Federal Reserve doesn't cut rates because inflation is coming down to their target. And if we're talking about weakness in the labor market, we're talking about an unemployment rate that is pretty much at what the Fed describes as full employment. And the majority of the weakness that we're seeing in the labor market is coming from government layoffs, and it's coming from AI-related layoffs, or in many cases, lack of job creation, because a lot of these companies are assuming that AI is probably going to be sufficient enough to do some tasks, as in they might not need to hire as much as they thought before. And maybe it's better for them to wait and see whether they need employees or not. And of course, the third element of the weakness that we see in the labor market is the stagflation that's going on right now, where we have affluent consumers continue to spend, but the non-affluent consumer is getting squeezed. So under all of these circumstances, when we have an inflation rate that is actually higher than the Fed target, and we have a labor market that is not weak, at least not right now, not showing any red flags or alarming signs. It is just reflecting the reality in the ground of the deployment of AI, the efficiency measures in government right now, and the nature of stagflation. So why do we see such huge bets that the Fed is going to begin to cut rates aggressively? The only thing that comes to mind is we have a systemic risk event. We have a financial crisis that will hit us where we least expect. Everybody right now is joyful and euphoric about the AI mania and equity prices going higher and shitcoins going higher and meme stocks going higher, and they're not really paying attention. So when I read the SOFR bets, I'm reading something is leaking, as in insiders are beginning to know that there is systemic risk going on, that there is a lot of, shall we say, fraud, literal fraud, and overpromising of future revenues and future profits that are not secured right now, and there is no viable way to verify whether these revenues and profit streams will actually materialize or not. But perhaps the most interesting phenomenon when it comes to the SOFR market is what we've seen today. Listen to this. Liquidity conditions. In October 2025, SOFR rose above the Fed funds rate. Really important and a huge red flag, signaling tightening liquidity in U.S. funding markets, which can also lead to divergence as banks show a stronger preference for immediate liquidity and high quality collateral. In other words, it seems that the Fed wants to loosen the policy, but the banks themselves are saying, no. Conditions been so loose. We got to tighten financial conditions and lending conditions right now, because there is a problem undergoing right now in the banking sector where maybe the lenders were too loose. It did not require a solid collateral or did their due diligence before issuing some of the loans that they've done. And that is, of course, coming to the story that we got today. You might have noticed that the KRE of the regional banks ETF has been plummeting as of late. And today it was an absolute massacre in regional bank stocks. It gives us sort of a deja vu of 23 when we got the collapse of Silicon Valley Bank. And of course, after that, we got First Republic and the Fed, at least, told us that they plugged the problem by flooding the market with liquidity. Well, apparently now all that liquidity has gone to waste, and they're probably going to have to interfere again. Here's the headline for you. Banks' credit cockroaches are spooking the stock market. Here's what investors need to know. Then a regional lender piled on one more thing. So they were talking about the problems with Jeffries, which we're going to discuss in a minute, but today we got another one. Another large credit loss, possibly stemming from fraudulent activities. In a regulatory finding, by the way, you got to remember, we called this the platinum age of fraud. And you're seeing the problem that fraud causes in actual life, in actual financial markets, in actual results. Keep that in mind, because at some point, when all's said and done, everybody's going to look for somebody to blame. And we can look for a lot of things to blame, but among them, the lack of a watchdog to what's going on in financial markets with all of the scams and the fraud going on. Anyhow, in a regulatory finding published Wednesday evening, Salt Lake City-based Zions Bancorp revealed that it would include a loan loss provision of $60 million in the third quarter earnings, which the bank is set to release later this month. Some $50 million of that will likely never be recovered, the bank added. The bank said it had commenced legal action against the two borrowers, whom it did not name in the filing. But we have an idea. Zions also stressed that this was not an isolated incident. Whoops. Translation. We were afraid about what happened with the regional bank crisis in 23 and all of our stocks plummeting, so we started being loose in lending policy. Now, we fucked up. We kept issuing loans without doing the due diligence, and some of these loans are now defaulting. So all what they did is just cook the books, push the equity price higher by issuing all of these loans, and now they're realizing that they cannot collect, and they have to do loan loss provisions. And they say it's not an isolated incident either. There are more, and it appears that this kind of activity is now widespread among regional banks. Anybody remember, by the way, the mortgage real estate crisis that we got back in 2008? 2009, when the lenders were just lending everybody, giving mortgages to anybody with no credit qualifications to buy homes they cannot really afford, and then taking these products, lumping them together with other high-quality assets and selling them in the market. They say, oh, this is different, but it's the same thing happening again. It's just that this crash is going to be a combination of everything we've seen before. A combination of the reckless lending that we've seen in 2008, 2009, the technological over-speculation that we've seen in the dot-com boom now showing up in the AI boom, and of course the consumer and retail investors mania that we've seen before the crash in 1929. This is going to be the mother of all crashes. This is why people say, Mav, you've been talking about this for years now. Yeah, because this event is going to change your life. You're going to wish that we warned even more about it because, as I said before, you're going to remember a world that we lived in before that event and a world that we live in after that event. And the two worlds are drastically different. Anyhow, Zion Bank was not the only one. Here it is. Investors could be forgiven for not taking that to heart because on Thursday morning, the market received another warning. This one from Western Alliance Bancorp. The Phoenix-based lender disclosed that it had filed a fraud lawsuit against a borrower for failing to provide adequate collateral for a revolving credit facility, although the bank added that it believed the existing collateral would cover the obligation and that it did not expect the dispute would impact its operating results. Trust us, bro. These disclosures might not seem like much in terms of dollars and cents, but at this point, investors are more worried about what is starting to seem like a pattern. Allegedly isolated credit events, said Stefan Inez, managing partner at SPI. We'll talk about that point in a minute, but check out Zion's chart here, the daily chart. It looks like it's the beginning process of a crash, as we've seen back in 23. So all of the rescuing that happened, all of the Band-Aid and the facade that they put in front of the regional banking crisis is now beginning to collapse. And the reality is being revealed that the Fed wasted billions and billions of dollars in liquidity, as they usually do, by the way. And at the same time, all what these regional banks did is fluff up the books with low-quality loans and just have the equity price recover. But now it's biting them right in the ass. And by the way, we have Comerica coming out tomorrow morning, CMA. That could be another disaster. And check out the Bank of Ozark. OZK, headline reads, they sold the parcel in failed $6 billion Chicago development. They gave the loans in the hundreds of billions of dollars, and this alleged $6 billion development didn't happen, and they have to eat a loss on it. So because of the regional banking crisis that we got in 23, a lot of these banks decided that the only avenue to recovery is to engage in high-risk activities. Don't forget that even private equity is subject to these high-risk activities, including fraud. For example, we all know what's going on with Jeffries. It's been catching headlines for days now. The stock is plummeting, dropping like a rock. And the reason is that one of the corporations that they lent to, First Brands, collapsed. So they're going to assume a total loss on that loan. And investors are beginning to speculate that this is First Brands is not the only one. They probably have more bad loans in their books that are yet to be revealed. That's why they're dumping the shares, sell now, ask questions later. I'm not going to assume the risk here. So again, all what we talked about so far, what is that a reflection of? A tighter policy, tighter financial conditions, or loose? Because the Federal Reserve, led by Jay Powell, keeps saying that financial conditions are tight, and we need to loosen them to help the labor market. But the reality suggests, if anything, the policy has been too loose, allowing this reckless lending in shadow banking, regional banks, and even private equity. But of course, everybody's looking past Powell now because his time is limited. So the candidate to be the next Fed chair right now with the better odds is Christopher Waller, who's already a Fed governor. He did interviews all over the place today suggesting that we should be cutting rates, that we need to help the labor market. So we need to cut rates. Now you have the new Fed governor, Myron. He's saying that he wants a bigger move. Don't just cut by 25 basis points, cut by 50 in the next meeting. Absolute insanity. This is politicization of the Federal Reserve, politicization of the monetary policy, where you have a new Fed chair nominee, Waller, who's obviously trying to appease the administration, who's looking for lower interest rates. And you have a new Fed government who's an implant by the administration, who's now trying to steer the ship inside the Fed toward cutting rates even more. Does that make sense to anybody? Especially when the inflation risk has not been eliminated yet. If anything, it has been amplified with the recent threat of more tariffs against China. And check out the price change year on year in food items. You're talking about 40% upside in coffee. Ground beef is up over 15%. Bananas almost 10%. You want to loosen the policy? You think that we don't have an inflation risk here? You got to remember, inflation has always been a monetary phenomenon. When the Federal Reserve cuts rates when not needed and issues liquidity when not needed, the result is inflation. And they end up wasting precious ammo that we need later on when the crisis actually hits. And right now in the labor market, they're using the labor market as an excuse, and they're not releasing the data with the government shutdown to keep us all in the shadows. Is that really a legitimate reason to cut rates when we have all of this risk right now? This is a really interesting interaction that I heard today on CNBC. Take a look.
Graphs, the blue line tracks inflation very well. Mm-hmm. The orange line, employment, it's so volatile. Directionally, it goes in the right direction when you total the five of them up, but it doesn't work on a month-to-month basis quite so well. You can see employment's flat from these five surveys, and that prices are generally elevated, though not as elevated as they were during the pandemic.
Is that what maybe Fed Chairman Powell is looking at?
It's not what I think is the case, actually. I mean, Chair Powell has said, we're in a difficult situation where the price stability mandate and the employment mandate are at odds with each other. And the Fed has said, without specifying any details in the past, the leg of the mandate that is further away from our objective is the one we will focus on. So inflation is close to 3%. These indicators, both from the New York Fed and what you're reading here, aren't showing very encouraging signs that we're going to be trending back to the 2% inflation target. And in the economy, the unemployment rate is 1/10 of a point above what the Fed thinks is full employment. So this whole idea that the balance of risks has switched to the labor market, the argument to me is very contorted. And the Fed, these surveys are good, but to be honest, we kind of ignored them when we had real data. So they haven't gotten any better. It's not like they say in the land of the blind, the one-eyed man is king. This is a case of the one-eyed man with the cataracts is king. It really doesn't track very well.
I want to emphasize what John is saying. You had Bowman the other day saying we're headed back to 2%. You've had Myron saying there is no inflation from tariffs. It's a bit of kind of wishful thinking out there.
It's very wishful thinking.
And that is spot on. The Fed thinking that by cutting rates, they're going to mitigate any risk they see or deem in the labor market is just acting God, but it has no functions or no supporting facts in real ground. Think about the government layoffs. If we cut rates, would the government say, oh, now I'm going to begin to hire again? That's not going to happen. Think about the large corporations who are replacing jobs and not hiring because of the deployment of AI. If you reduce rates by 25, 50, even a full point, would that really incentivize them to say, oh, okay, now we're going to begin to hire actual human beings? Think about the small businesses and medium businesses, the largest employer in this country, where we see legitimate weakness in hiring. Is cutting rates will really incentivize them to say, okay, now I'm going to begin to hire folks? They're not, because their problem is tariff is killing them, because tariffs are reducing consumer demand, and rate cuts or no rate cuts until they see consumer demand. What is the point of hiring employees? And cutting rates is not going to be a reason to do it. And we have now division in the Fed, where you got Minneapolis Kashkari saying that the economy may not be slowing as much as we think, suggesting that perhaps all of this talk about cutting rates is premature. It is an illustration that the Fed is a disoriented organization, that they don't know what they're doing in real life, and all what they do is just experimenting in attempts to manipulate financial assets higher, to serve the banks, to serve the elite. But they have no real life solutions to anything really. And all they do, again, is just touring and giving speeches at the expense of the taxpayer. It's an ineffective organization, and we're better off letting the rates being set in the free market than having the Fed. End the Fed. The problem is, if you end the Fed and let the rates dictated by the free market, this whole country is going to collapse, because rates will skyrocket given the insanity of the debt that we have and the deficits. So the Fed right now is just the plug between this nation and its collapse. It's not even a real plug. It's just based on manipulation, printing money, and depending on the dollar being the reserve currency of the world, which right now that's being challenged. If that is the case, and the dollar ceases to be the reserve currency of the world, then the Fed as a plug becomes obsolete. Now, when we talk about what we're seeing in banks, you have the JP Morgan, largest bank in the nation. Jamie Dimon says that he's warning of cockroaches in the U.S. economy. When he was asked about the situation of First Brands and Jeffries, he used the analogy that when you go to the kitchen at night and you see a cockroach, you ain't going to be the only one. There's probably more where that came from, suggesting, as Xeon's, by the way, admitted that this is not an isolated event. What we've seen in Jeffries, what we've seen in Xeon's, what we've seen in Western Alliance, and probably more to come, is a result of an environment that has been going on for about a year, 2 years now. And think of what's brewing behind all of this. Today, a tweeted rumor has it that there is a financial crisis brewing in shadow banking and private equity. The market might be sniffing it. That's the black swan. That's the danger that you're not seeing right now because it's not in the books. It's shadow banking, it's private equity. You have no access to that kind of data. But these shadow lenders and private equity firms have a lot of exposure to public markets. And if they go down, they take everything down with them. I want you to think about it, because you've heard a lot of narratives recently that this is a bubble, and they're drawing parallels between today and 1999 and the dot-com bubble. But the rebuttal to that, they say that, back in the dot-com, it was companies with no revenue. It was all of these dot-com stocks that really didn't have any legitimate businesses that were riding high. In this bubble, in this AI bubble, we have high-quality names like NVIDIA and like Oracle and Microsoft and Google. These are real companies with real profits, so this is different. This is not the same as 1999. Here's the problem, though. If you remember, and a lot of folks choose not to remember, what happened in the dot-com bubble, these shittier dot-com names with no revenue, no profit, began to blow up in 97. I mean, the Globe.com is the best case for that. But there were companies with legitimate profits and revenues and innovation happening, like Cisco, like Intel, like Qualcomm, like Microsoft, like Amazon, all companies that are large behemoth today. But nonetheless, they crashed by 60, 70, 80%. So to say that this bubble is different than 99 because we have high quality names of real companies, well, we had real companies back then. What do you think Cisco is? What do you think Intel is? What do you think Microsoft is? They all went down regardless because of over speculation. Now, The problem with drawing the difference between today and 99 is, where are the names that are highly speculative, that don't have profits, don't have revenues? Where are they? Some of them in the public market. I mean, OKLO is one example for a company that doesn't have profits or revenue. But the majority of these companies are in the private market. The majority of these companies are getting loans from shadow banking and private equity firms. And the problem that we have right now is there's a FOMO environment, where in private equity, they say, if we don't catch these companies, these little startups, even if they're not proven, if we don't catch them first, they invest in them first, we might miss on the next NVIDIA, we might miss on the next Cisco, and the next whatever. So because of FOMO-driven investment, they decided to give money and loans to a lot of companies that we've never heard of right now. And these companies are still not proven. Some of them don't have revenues, don't have profits. But the private equity firms think that they have potential when we have this AI mania going on. And they don't want anybody else to get into it. So they're pouring a lot of money buying shares in companies that are not really proven. And how are they doing that? Because the majority of their cash is deployed in the public market. They own Google, they own Meta, they own NVIDIA. The answer is they borrow the money on margin, on leverage, to invest in these unproven startups, AI-related startups. What happens if a major number of these loans end up being bad and rotten? Then a major private equity firm will be on the hook. And how are they going to liquidate? How are they going to raise the cash to meet their margins and their loan obligations? They have to dump the stocks that they own in the market. They have to dump Google. They have to dump Meta. They have to dump NVIDIA. They have to dump the S&P 500. And this is how the dots connect. This is how the dominoes fall. It's what's right now not being seen, hidden in the shadows, that could impact a connector between the private and the public market, and that could be these shadow banking firms, these private equity firms, with exposure to the private world and the public world alike. Think about this. Today we got some research from Deutsche Bank suggesting that consumer demand and spending for ChatGPT is actually slowing down tremendously, in many cases going negative. So when we go back to the example of private equity investing in all of these non-proven AI startups, because they think that consumer demand for AI is going to be off the charts, and they need to invest now and build the data centers now and do all these crazy things and hoard the chips, because we're going to see this massive demand coming from the consumer. What if in reality that demand doesn't really exist? What if in reality the consumer is too weak to spend on AI and this crap because it doesn't do difference in their lives really? Then the whole thing goes bust. And only then you're going to begin to find out who the cockroaches are, all of the bad loans, all of the bad financial activities. They're only going to be revealed after the fact. It takes us back to the great quote by Warren Buffett.
You can be doing dumb things and not know it in reinsurance, and then all of a sudden wake up and find out the money is gone. And it's what people have found out. And I used that line in the report a year ago. It's what people have found out that were speculating on bonds with low margins recently. That you don't find out who's been swimming naked until the tide goes out. And
now, before we conclude this video, folks, we've produced a market analysis video discussing all of the charts and the options market data and the gamma exposure for tomorrow's session, where the fix is going to go, etc., etc. So if you happen to be a member, make sure to check it out. I'm going to leave links in the pinned comment of the section below. If you're not a member, consider joining us to access the video and many more so you don't miss out on the daily coverage and the bonus videos. Links, once again, in the description of this video in the pinned comment in the section below. But with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
1637, 1797, 1819, 37, 57, 84, 1901, 07, 29, 1937, 1974, 1987. Jesus, didn't that fuck me up good? 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.